As the S&P 500 is rallying up to the upper boundary of a possible bear flag or a channel, we're seeing the VIX come down here and hit the trend line, and we've moved just beyond it with today's low. We are forming a possible bullish falling wedge here if the pattern can end up getting a breakout. Patterns forming as we're becoming very oversold on the stochastic for the VIX. S&P is hitting the gap fill and moving just beyond it and our 78.6 Fibonacci. The bullish reversal candlesticks that I talked about last Wednesday and Thursday played out. They've given us a rally back up. I expected a rally back up. I didn't know if we would go up to the upper boundary of the trend line of the current channel or overthrow that, move to try to fill the gap. We've moved to try to fill the gap and established a new boundary, as I'm talking about video and this week. Bear flag, but mixed signals. Here, the signal is still on a sell signal change. Some signals that are bearish, some signals that are bullish. It shows that, hey, we're going sideways at the moment, and a decision is going to be made. Either we're going to resume the decline, establish this as a bottom, and eventually break to the upside. We can form that divergence that I've talked about in the weekly time frame. I told you 3 weeks ago, nearly 3 weeks ago, we might have a bottom here. We tagged our 20-week moving average. I talked about that at great length and detail, showing you the chart. A lower high, or we can get a higher high. If we try to rally next week with the CPI, we could still try to form a higher high or at a later date. Go off at the CPI. Again, we can go back and establish a bottom or resume the decline. Here, the signal's still bearish. Momentum is up, but the trend signal is still bearish at this point. We have a rally that's something like this, where we had a rally, but it didn't flip the signal, and then we resumed the decline. Or does it turn bullish and all the signals begin to turn bullish, and we see the moving averages begin to turn bullish in the daily time frame? We still have the 10 and 20 below the 50, suggesting that we're going to at least go back and fill the gaps and maybe resume the decline if signals all begin to turn back to bearish. So we got a mixed bag of signals. Here, a bearish signal. Here, a bullish signal. This is telling us we're either going sideways or up now. Here, a bearish signal that, again, momentum is up. The trend is still down here. So a mixed bag of signals. Bullish, some bearish, really showing that we're going sideways in a trading range. Here, we've marked a short-term bottom. We've expected the rally back up again towards the moving averages, or maybe to try to fill the gap. Well, we ended up filling the gap. And again, momentum's turned back up. And this line represents a trend. We're above that level, but momentum is still below trend. And it's not yet being confirmed. We got a bullish signal, but it's still in negative territory. Well, we got bullish signals over here, but they were followed by bearish signals. The rallies failed. Even though bigger rally, they still failed, and we ended up turning back down to new lows. So is it something like that? We see everything begin to confirm a bullish scenario. Like here, I've got a bullish cross, and the signal turned positive. It wasn't fake like over here where it remained in the negative region. So again, there's more work to be done to establish this low as a bottom, or it's a counter trend and we're going to resume the decline. We're at a key level of resistance now. Do we clear it? Do we get rejection off of it? And if we do get rejection off of it, do we go back and get a higher low, establishing a bottom, or do we resume the decline? Waiting game now. Mixed bag of signals. The signals are mixed. I'm looking for a resolution here. We have momentum bearish. The trend is still bearish. Still a bearish signal. Other signals, I can go through the charts and show you other signals, as I've shown you a few, are bullish. I'm going to be looking for a resolution here. Everything to turn back to bullish. Everything to turn back to bearish. Please support the channel with the link directly below. That allows me to be able to provide you this information. Like the charts, let me know that. Supporting the channel today. I don't have any sponsors, just a direct relationship with you. Just consider supporting the channel. I'll have a link below to take you to a secured site. You can donate any amount you want. If you can consider taking a moment to do that, I would really, really appreciate it. I thank you for that. Again, nearly 3 weeks ago, I talked about the low we were hitting on that Friday, 3 weeks from tomorrow. Weeks ago from tomorrow, we're hitting the 20-week moving average. I told you we might have a bottom there. We may go up and get a bounce and take this level out and then get a bigger bounce and try to fill the gap and hit this upper boundary, or we may get a bounce and try to fill the gap and establish a lower high and then turn, much like what we had back at the July peak over here, where I told you we could attempt to see this bottom out and eventually make our way back up to the upper end of the channel. Now, if we start clearing levels directly overhead, then you got a shot at that scenario happening. But I've been talking about this before we ever reach a 20-week moving average, because I told you I thought that's where we were going, probably going to bounce off of it, because I had drawn the channel line, a parallel channel with the upper boundary daily time frame, and I showed you all that at the time. We were moving towards the 20-week, and then after we tagged the 20-week. Still see a pullback and still see the 20-week moving average hold. Over here, we bounced off of it. We came up, we had a big rally, going back up towards the highs, just like what we're doing right now. But then we came back and we hit the 20 again. And we could see that happen. We already did bounce off of it for 3 weeks straight, but we could still come back to it if we go back to fill those gaps, and it could still hold. But this is still a possibility at this time. Or if we turn down, we can resume the decline, and if we do, got the 20-week moving average, you can get a bigger sell-off and start moving towards the 50-week moving average. You can start moving towards maybe this trend line here, start moving towards the 200 in the daily. Things to be aware of. Again, I told you when we hit that 20-week 3 weeks ago, I'm looking for either a lower high to set up or a higher high to set up and form a negative divergence. We'll be watching to see how it unfolds. And again, it still may be, even if we get a sell-off, it's a 20-week again, or even slightly overthrow it. Again, we still may be in a bottoming process. I told you to be watching with the Fed meeting. Do we get a post-Fed bottom or a post-Fed sell-off with a continuation, trend extension of the previous decline? Things to be paying close attention to in the weekly time frame. And don't forget, we still have those negative divergences on the indicators for the NASDAQ. I talked about that in yesterday's video. I think the next sell-off is going to be important, and if we start selling off, we fill the gap, we'll be watching to see if our low from 3 weeks ago can hold. We'll be watching the 20-week moving average to see if it holds. So far it has. Okay, the market rallies. S&P moving to the upper boundary of a possible bear flag pattern as the 10-year pulls back to fill the gap. We got that bottoming tail. We pushed higher, coming back, filling the gap. Now you need to see a follow-through. 10-year bounces in this area. S&P can complete the divergence and begin to turn in the 60-minute time frame. That's what I was watching for. The S&P didn't break down with the gap fill, testing of the 78.6 Fibonacci. We can get a divergence on the 60-minute chart and hit the upper end of the channel or the upper of a possible bear flag. So again, I'm watching this trend line, and if it breaks, so again, you got your moving averages here, the 50 period and horizontal support. It was a turn off the upper boundary that gave the S&P a bottom 3 days after the touch of that trend line. S&P bottomed out, saw them diverge. The 10-year went slightly higher. The S&P got a higher low, and we've had this rally, and we've seen the 10-year pull back now to this trend line. So I'm watching. Again, we've had the trend line touched several times, and each time we've reached this level, we've seen a significant bounce off of the trend line. Again, the last time when we hit it, the S&P peaked, and we saw the surge. The S&P dropped. 3 days later, the S&P bottomed here and slightly higher. They diverged from one another, and we saw the 10-year pull back, and we saw the S&P rally. So now, in the trend line, the 50 period and horizontal support. Now, likely see yields rise next week with the inflation data. We'll get the PPI inflation data and CPI inflation data. We'll get the producer price index next Tuesday before the market opens on the 14th. That is wholesale inflation. They don't have the numbers here, but before the market opens. And then on Wednesday, we'll get the CPI on May 15th. So that's going to be next Tuesday and Wednesday before the market opens. Rally will likely be followed by a sell-off surrounding the CPI data, the PPI data, or both. We've had 3 months of hot inflation reports. Now we're rallying ahead of the next inflation report, setting up for a CPI or CPI and PPI sell-off in all likelihood. I was watching this trend line on NASDAQ all day because, again, at turning points in NASDAQ and the S&P, they diverge from one another. We had that happen back over here. The NASDAQ peaked here on the 21st, the day after the Fed meeting. Okay, and then it sold off and it came back and it made a lower high. Well, the S&P made a higher high right there. It made a lower high. It's doing the same thing right here. We turned down and we've come back up and we're stalling at this trend line right here and the 78.6 Fibonacci. S&P is overthrowing it and forming a divergence while NASDAQ is getting a lower high. They are diverging from one another. We are forming a lower high on NASDAQ and a higher high on the S&P. Now listen carefully. The signal may not play out if NASDAQ can go higher. But I'm watching to see if it can't. S&P turns with the divergence on the 60-minute chart, possibly get a turn near the 78.6 Fibonacci. Dow hit the 78.6 Fibonacci today and gap resistance. It has not yet filled the gap. Dow had a bigger sell-off. The Dow would come back and fill some gap, get a rally back up off the 20-week moving average, and we're watching to see where it ends. But here you can see we have another possible divergence. Again, it may not be plays out if NASDAQ goes higher, but at the moment, NASDAQ is making a lower high, stalling at the trend line of resistance, while the S&P is going higher just above our gap fill area and the 78.6 Fibonacci. And again, it was a divergence that marked the turn at the top. Our last peak here, it was a divergence that marked the peak back in at the July top. NASDAQ couldn't make a new high. The S&P did, and other turning points as we were selling off marked turning points with short-term bottoms and tops here. We eventually bottomed and started a new uptrend. So again, here's a divergence. May or may not play out. I don't know, but I'm just bringing it to your attention. It's something I'm paying attention to. Maybe it gets canceled out. S&P has come up to major resistance, stalls there. Then we could complete this divergence between the two. So it's something I'm watching. Now it's NASDAQ. NASDAQ 100 was up 28 points today, 0.16. Lagged behind the Dow, it lagged behind the S&P 500, and that's creating this little divergence right here so far at this trend line. Now, we have NASDAQ at the 78.6 Fibonacci. The S&P moved to a higher high. S&P outperformed the NASDAQ today. It was up over 0.5%, just slightly over at 0.51%. The S&P up 26 points, and we came bouncing off of the cloud here. I talked about this, and I told you, I've talked about this scenario. We couldn't take out the 200 period on the 5-minute chart that we could try to bounce up to this trend line. I talked about that the last couple of days. That seems to be what's happening. We're moving up here, and again, filling our gap the other day, turning down, rebounding back up, pretty much closing flat the previous 2 days, and then now we have this gain of about 0.5%, moving up here, and our rising wedge broke down, but we corrected sideways, and that's now formed this channel going into this larger channel, which could be a possible bear flag, as a divergence could be carving out here. So again, S&P moving higher above this peak, the NASDAQ is not. NASDAQ moves above that peak, that signal will mean nothing. But it's just something we're paying attention to, because again, when S&P gapped higher the day after the Fed meeting right here, NASDAQ peaked, the Dow peaked that day, and we had a post-Fed sell-off. S&P went back and went 3 points higher above that high, and it diverged with NASDAQ, and then we got the sell-off. To see, are we again going to set up a lower high surrounding the gap fill area in the 78.6 Fibonacci, form a bear flag and come down and resume the decline, get something like this? Or are we going to come back and form a bottom and the support here off of the 20-week? Remember 3 weeks ago I talked about a possible bottom at that 20-week moving average. That was right there. That'll be 3 weeks from tomorrow that we talked about that possibility on the 20-week moving average in the weekly time frame. Told you we were going to bounce. Told you again we were going to bounce right here. We had these lows right here form an inverted hammer on the day of the Fed, and then a bullish hammer candlestick the very next day, last Wednesday and Thursday. And I told you we were going to rally back up likely to the 200 period moving average, or the trend line here, and test that. We overthrew that trend line. And I told you if we ended up overthrowing the upper boundary, then I'll be watching the gap fill and the 78.6 Fibonacci. About all of this back down over here or up here, overthrown the upper boundary. We have another one from this level that I'm watching right here, and again we're right at that level. As we're hitting this level and coming to it here, we're forming this divergence on the RSI. So I'll be watching this level. We're getting the 50 back above the 200 now. Sometimes when you get those golden crosses, you see peaks happen. And the crisscrossing back and forth of the moving averages are telling us that, again, we're going sideways or now up. Have the 10 and 20 below the 50 on the daily chart, which tells us, again, the same thing. Watching for is, do we get a post-Fed bottom or a post-Fed sell-off, a continuation of this decline, completing a bear flag pattern? It is possible that if we complete a bottom or pull back and get a higher low, again, that we could still be on our way, making our way up to take out these highs and form a divergence, as I've talked about in the weekly time frame. Again, we could form a bottom, so I'll be watching the next sell-off to see what happens. But you got a channel here. We could see a sell-off surrounding the inflation data, and I'll be watching, does the horizontal support zone hold here? Does the trend line hold? Start taking these levels out and resuming the decline and see something bigger, something uglier. Rally scenarios that I talked about to the upper boundary of the channel or back up to fill the gap, that's now happened. So now it's the waiting game to see what happens here. We're waiting, negative divergence is forming. As the S&P is moving up towards that upper boundary, I do want to draw something to your attention on the 60-minute chart, and that is that during the session today, we completed a 13.9, the 60-minute chart. Now, again, sometimes these counts don't play out. If you get an immediate trend extension, it can happen, okay? But they produce reversals, like right over here, or corrections. Okay, we get it, and sometimes you get it, and you go a little higher like we did here or over here, but you still get the correction. Here we had a bottoming candle, a bottoming count, I should say, and we went a little bit lower. Here we went a little bit higher. So again, these produced turning points, but it's not perfect. No indicator is. Here we had a 9 count. We got an immediate trend extension. We got a 9.9, and then we got a correction. And then we got the trend extension that followed. We went on and we got a 13 and we got a 9 today as we're coming up here. And again, we're right here at this level. So again, you're getting a 9.9 followed by a 13.9. This is showing that there's some price exhaustion going on. Eventually, again, we're likely going to come back, fill this gap, fill the gap over here. And again, we need to be watching what happens. Do we pull back and take out trend line and go to the support zone and bottom, or do we try to take out this low right here? And again, you've got your support zone, as I've mentioned here. You've got your lower boundary of a possible bear flag. If we're going to get a trend extension to the downside, resuming the decline. So again, it's the waiting game now to see. It's really all about support and resistance. But again, the next sell-off is going to be important. Should we turn off of this level? Now, if we clear this level, again, a lot more signals are going to start turning bullish. There's a possibility of new highs and a larger divergence, as I've talked about in the weekly time frame. But you do have 13.9 completing today. 9 here produced a pullback. The 13.9 here could produce a reversal. Counts are not perfect, but I'm just showing you this because it is showing in the 60-minute time frame that we are getting price exhaustion here on the S&P. As we had the sell-off give us price exhaustion down over here. Sometimes the counts don't play out. Did you hear what I said? Sometimes they don't play out. Sometimes you get the trend extension. The count is warning that we could get a pullback like we did right here, here, and here, or a reversal like we did over here in the 60-minute time frame. S&P 60-minute chart. Now, just quickly, as the Dow's rallied up to the 78.6 Fibonacci, which I'll be talking about in this video, and we have the gap filled directly overhead, we're at gap resistance, we've become overbought again at extremes. So I'll be watching to see if we stall out at gap resistance and the 78.6 Fibonacci, or try to fill the gap with the Dow. The Dow playing catch up to the S&P and NASDAQ, outperforming both of them today. We are at extremes. We're going higher. S&P is forming a divergence as we're coming right up to the upper end of this potential bear flag or channel. Turned back up today. Again, I talked about yesterday we had a triangle. The triangle had an upward resolution. Now, again, we're right here. I'll be watching. Does this roll over immediately, or do we try to blow past this level and challenge the highs? And if we clear this area, then you're clearing some serious resistance. You're throwing the 78.6 Fibonacci right now and overthrowing the gap fill, but we're coming up to this area. And again, resistance level I'll be talking about at the end of the video, which I think is the line in the sand. And if we clear that level, it's a sign of strength. We turn down, then we can either go back and fill the gaps and establish this as a bottom and get a bottoming process, or see the moving averages all turn back to bullish in the daily time frame. They're still in a bearish arrangement. Suggesting we're going to go back and fill the gaps. But if we begin to establish a bottom, then you could still go make new highs. It's a bear flag, and we start coming back and breaking this trend line, taking out support. Said, I get the downward trend resuming, like what we had over here. So I'll be watching again. Does this divergence play out immediately, or does it not? And we still try to blow past this level. We're watching to see if we close tomorrow above the 10-week moving average, or do we sell off and close back below it? We were trapped between the 10 and the 20-week moving average. This week we're getting above the 10-week moving average to be able to stay above it in order for it to be bullish. If we drop back below it, see what happens with the next sell-off. We'll be watching. Does this divergence play out immediately, or do we blow past this level now, or do we turn down off of this level? Have a divergence on the RSI and other indicators. Bullish divergence here gave us the reversal. Will this one give us a reversal, or just a pullback, or do we go higher before it completes? I'll be watching. The Dow is already at extremes, as I just talked about. Dow has a 7-day winning streak. I'll be watching to see if that winning streak now breaks. It's rallying ahead of the inflation data next week, which we'll be getting Tuesday and Wednesday before the market opens. I'll be watching the gap fill. I'll be watching gap resistance, which we're currently at 78.6 Fibonacci. Now, as the S&P is rising to a higher high here of our last minor high from a few days ago, overthrowing the 78.6 Fibonacci as the Dow is reaching it, we're seeing the Dow rally on earnings, and we're hitting the 78.6 Fibonacci, catching up to the others that have already reached it. S&P's slightly overthrowing it. NASDAQ's turning off of it. Directly above that, you have your gap fill there on the Dow. So again, watching these levels very closely as the Dow's now playing catch up to the S&P and NASDAQ. Dow is currently stalling at gap resistance and the 78.6 Fibonacci. The gap resistance here may fill the gap, may not. I'll be watching to see what happens with the Dow. NASDAQ so far has turned off the 78.6 Fibonacci after just overthrowing it 3 days ago. We hit the 78.6 Fibonacci and we turned down off of that level. Today, the NASDAQ got a possible hanging man. I say possible because candlesticks mean absolutely nothing unless they're confirmed. Back over here, I told you that we had an inverted hammer. It didn't get confirmed the next day. The next day we got a hammer. I told you both of those candlesticks, we need to close above them in order for it to be a bottoming candle pattern. And we have back-to-back bullish candlesticks. I talked about that, did a whole video on that. They were both confirmed the next day on last Friday. We moved up to the 50. And this week we're getting above the 50 period, and we're going up again above the 61.8 Fibonacci to the 78.6 Fibonacci. If NASDAQ goes higher, we still have this gap fill up here. We still have Dow with the gap fill directly overhead. S&P has already filled all of its gaps. Now we have gaps below that could be filled. We're watching the 78.6 Fibonacci as NASDAQ so far gets a lower high as S&P gets a higher high. And again, that's what happened over here, as I've said. If NASDAQ goes higher, if the Dow, S&P go higher, and this gap fill comes into play, and the 78.6 Fibonacci will be blowing past that. The 78.6 Fibonacci levels could act as resistance. S&P is slightly overthrowing it. NASDAQ overthrew it and turned down off of it. S&P 500 has slightly overthrown the 78.6 Fibonacci. We tagged it there 3 days ago and then pulled back, and then we kind of closed flat yesterday, closed flat the day before with the doji, and now we push higher, slightly above the 78.6 Fibonacci as NASDAQ turns off of it. We'll be watching to see, do we continue higher, try to reverse off of the upper boundary of the channel and complete a divergence on the 60-minute chart. Again, over here I talked about a possible bottom. This candlestick, again, I drew a trend line in before we ever reached this level as we were falling down over here because I thought we were going to come back and fill this gap. And I told you the 20-week moving average was right at a parallel trend line. I told you that could mark a bottom. May, but I told you that we were likely going to rally back to the moving averages, back to the upper boundary here of the trend line that I talked about. Through that, and I've told you that, again, if we got above these levels, then our gap fill and our 78.6 Fibonacci comes into play. Expected a rally there, and then I told you that, again, I expected the rally here last Wednesday and Thursday because we never did reach the 200 period moving average on the 60-minute chart. So we got that the very next day. We hit it. We're just shy of it, and then on Monday we hit it, overthrowing the 50. We hit it on Monday overthrew that level and continued on higher to our 78.6 Fibonacci in an attempt to fill the gap. So these are the levels, the gap fill and the 78.6 Fibonacci that I talked about, the 61.20 Fibonacci and the 200 period there on the 60-minute chart and the upper boundary. We talked about all these levels of resistance back over here. I expected a rally there. I expected a rally here. But right there, I told you I didn't think it'd finish because we never did reach that 200 period on the 60-minute chart until we bounced off of this level here. And we bounced off the trend line. We kept bouncing off the trend line. We talked about that at great length of detail. So now the question is, establish a lower high and turn down, form a bottom, go higher, and make a new high? Or is this a counter trend? We're going to resume the decline, and that's what I'm watching now. Again, the 10 and 20, 10's above the 20, but they're still both below the 50. You got the tangling of the moving averages, and if we see the 10 get back above the 50 again, we're really going sideways. So a decision is going to be made. Either we're going to resume the decline or we're going to go up and try to make new highs. If we try to go make up new highs, we'll probably pull back, establish this as a bottom, eventually see the moving averages all turn to a bullish alignment if we form a bottoming process. Don't, then again, the decline can resume if we take out the trend line that I've talked about, the 100 period moving average here. Now, pushing up into the 78.6 Fibonacci, I want to show you this. I talked about this yesterday. Again, this line right here is right here where our upper boundary is on the S&P 500 for the bear flag. Also be a bullish channel if we find support, come back and fill the gap and find support in this area or just beyond it, and maybe the trend line changes. But we're hitting the 78.6 Fibonacci here, and we're filling the gap here, just slightly above that. And, we're coming up to this trend line here. It's the S&P daily chart. In an uptrend, this line tends to be support. In a downtrend, this line tends to be resistance, and we're right there at it. Now we start getting above this line right here, or get above it briefly and then pull back and then build upon that and maybe hit the trend line and get above it. That's going to be bullish, and we'll likely go make new highs, and you can get a bottoming process. Again, you could come back and test this low at the support zone and still come back up to that level. But this is an area where we tend to see rallies, if we are in a larger downtrend, fail. Okay, this level right here. What happened after the July top? During the sell-off of 2022, counter-trend rallies often stalled at this area. When we got above it, we got a bigger counter-trend rally August of 2022, the summer rally of 2022. This is an area where we tend to see resistance. We broke below it. It acted as resistance. We pushed down further, and now we're coming back up to it. We could overthrow it a little bit, but again, this is pretty much the line in the sand. Separates the bulls from the bears. So, and again, we're right here at the upper boundary Like on the 60-minute chart, it was just slightly below there. And I'll be watching this level right here as we're forming negative divergence on that 60-minute chart. Again, the blue line acted as support during the uptrend, and when we broke it, the black line, secondary level of support. After the July peak, when we lost those levels, black line is resistance, but then the blue line acts as a secondary level of resistance. Here we found it at the black line. Here we found it just below the blue line, which is right where we're at right now. We have a counter trend that's something like here or something like here. You know, these counter trends that ended up giving us a series of lower highs and lower lows. So it's a $64,000 question, but we're right at this level of resistance, forming a possible bear flag pattern. And if we see it break down, then you can get a measured move, which would be a continuation of this move down, which was 6%. So again, I'll be watching this level closely to see if we clear it or get rejection at it. We might get rejection at it now, form a bottoming process, and then clear it later and still try to make new highs. But again, we're at some major resistance, and in my mind, this is the line in the sand as I talked about yesterday.